Hello again from all of us here at Robare and Jones. Hope you're doing well. Hope you're as excited as I am to welcome some of this cooler weather that we're expected to have over the next week or so. It was a hot summer, a very dry summer outside of the last few weeks. Seems we got all the rain all in a couple weeks, but that's all right. I wanted to make this video to give you a quick update about the rebalance that we have coming up in the next couple of days. Our equity portfolio, we're going to be increasing our growth allocation, so our allocation towards growth companies within the S&P 500. So we're focusing on the large cap domestic companies really only. But because what we've seen in the equity markets has created an opportunity for the growth side. We've had a lot of the negative pressure on the S&P 500 can be attributable to those growth companies. But we want to be strategic on the kind of growth companies that we add to the portfolio. You know, the top 10 holders of the S&P 500, or the top 10 constituents, before they were revenue weighting kind of matched each other, but now we're seeing that divergence. Okay, so we instead of 30% weight plus 30% revenue contributions or earnings contributions, now we're seeing something close to about 28, 23, 24% contribution. So we want to be strategic on that. Make sure that we're not adding money to something that could be overvalued now. But we do think that the growth side of the stock market is way more attractive than it was, say, 2 quarters ago. So to do that, we're going to be swapping out one fund that's VLUE for another fund that's RPG. So it is still a targeted growth fund, but we do not have the overweight to the Apples and Googles that we have had in the S&P 500 for the last really decade. On the fixed income side of things, our cash overweight remains unchanged. So we are going to be re-upping our cash allocation, but we're not increasing or decreasing it overall. We want to have that dry powder and also that kind of anchor or stabilizer to the overall portfolio. So we're going to be ranging from 10 to 12% cash on the most conservative allocations, all the way to 5% even on our most aggressive allocations. On the fixed income side, again, we're going to make it a lateral change. We're going to be getting rid of a TIP position or a treasury or inflation protected treasury position that's a bit longer dated, so it's going to be more interest rate sensitive, in exchange for a slightly larger weight to short-term TIPS and traditional intermediate term treasuries. We're doing that both as one is price change. So as interest rates rise, we expect the traditional inflation protected treasuries that aren't just pure short term to be affected more in their price than the benefit of the inflation protection that they offer can provide. As well, the normal treasuries, just without the inflation protection, offer a better hedge against a falling equity market if that were to arise. Now, we're not making this change because we think the equity markets are going to fall off a cliff. In fact, there's arguments why that won't be the case. Of course, there are arguments that it will be the case, but we always like to be situated for all probable outcomes. And so with that being said, we do want to increase our overall hedge to equities in a traditional way in the event of an equity market correction or continued equity bear market. Treasuries historically have offered a better hedge to those prices. As equity markets fall, that money needs to go somewhere, and the treasury tends to be the safe money. This is why we use, and you hear us talk about the 10-year treasury rate all the time. But that being said, that kind of is a quick summary as to what the changes that we're going to be making. If you have any questions, or if you would like more detail, feel free to shoot us an email, give us a call. We look forward to seeing everybody soon. And whether it's in our next quarterly investment forum or in person, we look forward to seeing you.